Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 78, and I had a thought a few weeks back that it might be fun to focus on a few financial and investing myths that I run across on a frequent basis amongst other practitioners in the financial media, amongst people that we speak with in our financial planning firms. And so this week, I want to focus on one of those myths and then pick up other myths in subsequent episodes over the rest of the year. But this week, I wanted to focus on the concept of bonds and interest rates. And there's this popular idea that interest rates are going to rise inevitably, and that's going to just totally decimate the returns that you might experience in a bond portfolio. And that's not entirely true. Number one, I don't think that we're in for some hyperinflationary period over the next decade or more. But even if we are, that's not necessarily going to crush the returns that you'll experience in a bond portfolio for a number of different reasons. So in this episode, in our episode this week, I talk about why that is. We talk about some of the math that goes into this and what duration actually means. And we cover a really good blog post written by Cullen Roche, who has a great blog called Pragmatic Capitalism. You all should read if you're not familiar with it already. Okay, I think that does it. I hope you enjoy the episode. Hey, everybody. Real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. So this week on the podcast, I want to focus on one of the financial myths I hear openly discussed all the time, everywhere, both in the financial media, amongst some practitioners, amongst people that we speak with about their financial planning needs and their personal finances. And my thought here is there are a couple, maybe 3 to 6 different myths that we hear perpetuated openly all the time that are just totally pervasive to our culture. And what I'd like to do over the course of the next couple months is just devote an episode to each of them, talking through each of these myths and debunking them from our perspective as financial planners who believe otherwise. And this week on the podcast, I wanted to focus on the concept of duration in bond portfolios. And this idea that if interest rates rise, you're going to lose money on your bonds. And it might sound shocking to hear me say that because I've talked about duration on the podcast in the past. I've talked about how bonds do lose money when interest rates rise. And when you think about it and actually work through the math here, that in and of itself, is a little bit misleading and is something that I would classify as a myth. Because while it's mathematically true that the price of a bond that you hold in your portfolio is going to fall if interest rates rise, that doesn't necessarily mean that you're going to experience lower returns. And so what I wanted to do on the podcast today is just talk through this and why I think bonds still have a place in your portfolio. I wouldn't dismiss them entirely, although I do think that we should not expect the same level of returns from them in the future that we have in the past. So let's jump into this piece by piece and just review what duration means and why the price of bonds in your portfolio fall as interest rates rise. The idea here is a bond is a lot different than a stock. It's a totally different financial instrument. And when you buy a bond, most of us buy bonds through funds, through ETFs or mutual funds. But you can also buy individual bonds through the secondary market or original issues from a borrower like the US government or a corporation or your local government, state government perhaps. There are all sorts of these bonds that are issued in the capital system. And as part of our monetary system, they're very handy mechanisms for organizations to borrow money. So when you buy a bond, let's just take the easy example of you're buying it directly from an issuer. So if Apple, for example, wants to, they have this great new idea that for some kind of product that they want to finance, they might go and borrow money from the capital markets by issuing a bond. And they might say, we want to borrow $400 million in order to finance this really cool product idea that we have. And so they go to an investment banker and tell them that they want to issue bonds, and the investment banker will help them structure that deal and actually raise the money. So the investment banker turns around and goes into the bond market by talking to various bond dealers that they have relationships with, and basically raise money on behalf of the corporation, on behalf of Apple. So let's say that the result of that deal is that they issue $400 million of bonds that pay 2.5% per year in interest. And they are, let's say, 10-year debt obligations. Well, when you buy shares of Apple stock, you're buying the equity of that company. And the price of the stock is going to go up and down based on the performance of the company, based on the market's perception of that performance and ongoing expectations. And the way that you're going to be rewarded for that investment is if the price of the shares go up, or if Apple decides to distribute some of its earnings in the form of a dividend. But there is no termination, there's no end to that deal. You're an equity owner, a part owner of Apple, the corporation. And that just goes on in perpetuity unless Apple goes bankrupt and just goes out of business, or you decide to sell your shares at some point. With the bond, that's not true. With the structure that we're talking about here, let's say that they have $400 million of 10-year debt obligations issued, and the rate that they're paying is 2.5%. Well, if you buy one of those things, usually they're issued in $1,000 increments. So you can buy $1,000 of that bond offering. And in exchange for that $1,000 that you're lending to Apple, the corporation, they're going to pay you 2.5% interest on that $1,000 per year, or $25. Typically, the way these things are structured is the corporation or the issuer in this case, or a corporation in this case, or the issuer, pays that interest in semi-annual installments every 6 months. That's called a coupon payment. So as the bondholder, you might have that bond sitting in your brokerage account. You're going to get $12.50 deposited into your account every 6 months by Apple. And then when the 10 years is up, the deal is over. Apple repays the bondholders, they repay their loans, and you have that $1,000 that you invested in the bond initially deposited back into your account, provided that Apple is still in business and able to make good on their debt obligations. So the concept of duration, and I think what everybody is so focused on, is because interest rates are so low right now, and have been for a while, but continue to grind lower and lower and lower. People are concerned that the only direction that rates can go now is up, and that's going to impact their bond portfolios negatively and cause them to experience negative return on their bonds. And this concept of duration is basically means that, if you go and participate in that bond issue and buy bonds that Apple's just issued and on which they're going to pay 2.5% over the next 10 years. Well, let's say that you buy that $1,000 worth of that bond, but then the market rate of interest changes. Interest rates just spike for whatever reason. Maybe inflation kicks up and the Federal Reserve has to raise rates by a little bit, or maybe the market expects inflation to accelerate. And so therefore the market rate of interest on 10-year issues goes up, which is more relevant to this situation, to be honest. Whatever the case may be, if Apple decided to do another debt issue a couple weeks later, but at that time they were forced to pay 3.5% per year on their 10-year debt issues, same company, same credit worthiness, same details of the bond issue, but now the market rate of interest has changed to where they have to pay 3.5%. Well, the price of your bond in the market is going to fall. Bond prices fall when interest rates rise. That's a mathematical certainty. So because of that, we think of interest rates going down over the last 30 years to where they are now and at an ultra low point. A lot of people around the country are just assuming that we're going to see a spike in interest rates as the economy takes off and as inflation picks up again, and therefore it's going to produce negative returns in your bond portfolio. While it's true that bond prices fall, that's really only in the short term. And if you are focused as a long-term investor with a consistent strategy that's executed consistently, then you're not tremendously likely to see negative returns over the long run. Bond prices are not the same as bond returns because there's an end to the deal. And in the example we gave, after 10 years, you get your money back. You have that cash to reinvest in something else at the market rate of interest at the time. And you get the $25 a year in interest coupon payments between now and then. So it's kind of an interesting, I wouldn't call it a paradox because they are different things. Bond returns are not the same thing as bond prices, but they are certainly related. So what I think a lot of people like to bring up in when discussing this topic is that interest rates went way up, all the way up to 15, 16, 18% back in the 70s. And they say, well, we're in this period where inflation could really come back into play. We had a larger than expected inflation number printed here a couple of weeks back that we talked about on the podcast last week. And if that happens again, that would just totally decimate my bond portfolio. I don't think that's true. First of all, I'll talk about why that's not the case if that happened. And secondarily to that, I want to talk about why it's not even an accurate apples to apples comparison in the first place. But before we get there, let's talk about why your bond portfolio is not likely to experience such substantial losses. And there's some math involved in this, and I'm going to rely on a really good post on this exact topic that I'll reference and we'll reference in the show notes. But because you get interest every single year in your bond portfolio, that interest can be reinvested in market rates at the time, which means that if you buy a 10-year bond today and then market interest rates go up, that $12.50 you get every 6 months can be reinvested at the market rate of interest then, which goes to dilute the impact of duration in a consistently applied portfolio. So there's a really good blog out there it's written by Cullen Roche, who is an investment manager himself, and his blog is called Pragmatic Capitalism. I encourage everybody out there to read this because he has a very good perspective on macro investing. And a few years ago, he wrote a really good blog post titled "The Worst Case Scenario for Bonds," where he runs through the math of what would happen if you had a 7-year constant maturity portfolio of U.S. government securities paying 2% per year. And then every single year after that, interest rates rose by 1% before leveling off at 15%. And so he chose that as a worst case scenario because that is what happened in between 1940 and about 1980. Is interest rates steadily went up, 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 up before leveling off at 15% over 7-year issues when the Fed finally got inflation under control. And so what he did was went through and evaluated what the long-term returns of a U.S. debt bond fund or a group of bonds, whether you buy it through a fund or a bunch of individual bonds, might be if you experience that exact situation. And so this is what he did. He assumed that you have a 7-year constant maturity bond portfolio, which means that you have 7-year debt obligations that you hold. You lend money to the U.S. government. You get 2% interest back every single year and your money back after the 7-year period is up. And so he assumed that the market rate of interest on that similar portfolio went up to 3% in year 2, 4% in year 3, and up and up and up and up. What he found was, after running the numbers on that, and I can't do the math in my head, but it's a relatively simple spreadsheet if you wanted to put it together yourself, is the low point for that portfolio is 9.6% off of its high. And before I go any further, I might add that the 7-year maturity is a good proxy for bonds that you and I hold in our portfolios. And the reason there is most bond indices, so for example, the Barclays US bond index, the average maturity is right about 7 years. And it includes corporate bonds, it includes US government bonds, a mix of the two in order to represent the bond market here in the United States. And so obviously we have 10, 30-year US government issues. We have bonds that are with durations greater than 7 years. We have a lot of bonds with durations shorter than 7 years. But when you add them together, the weighted average duration, weighted average maturity is right around 7 years. And so if you take that portfolio and assume that you're getting 2% per year on day one, and rates start going up and up and up like they did between 1940 and 1980, the worst point along that trajectory was a drop of 9.6% off of its high. And after you lose that amount, after you hit that low point, so if you put $1,000 into it, you lose 9.6%, which would leave you with about $840. It starts to climb back rather rapidly because the coupon payments that accumulate after that initial period start to get reinvested, and you rebound from that low point rather quickly. And when you look at the total return of that portfolio over the entire 14-year span, the average annualized return over the entire time frame is 2.85%. So that's about what we would expect in a portfolio like that anyway, and that's during a time where interest rates go from a very low point, maybe a little north of where they are today, but very low point, to as high as we've ever seen them in the past. So it's if you think that we're in a period right now where we're about to see rates spike and that's going to negatively impact bonds, I don't know that that's necessarily the case. Because duration is a mathematical certainty, if interest rates spike, it's going to cause a short-term drop in the value of your bonds. But that doesn't mean that you're necessarily going to lose money in them. It just means that the price of the bonds that you own in your portfolio will be temporarily suppressed. I would argue, as always, that the path to the best outcome is a consistently applied strategy. And if you have a long-term focus, like we should in the first place, you will earn that back over time by just being consistent. So that's the takeaway I get, is even if you believe in that worst case scenario, bond portfolios still do okay. And because we're starting from a very, very low rate of interest today, if rates do spike back up to 15%, you might not get quite 2.85% over the long run. But even if you get half that or 1.5%, it's still a beneficial buffer to your equity allocation in your portfolio over long-term periods of time. So this case for getting rid of bonds in your portfolio because rates are low and bound to destroy the value of your bonds, I think is a little bit short-sighted. And just by being consistent, we'll be able to drive long-term returns that might not be what we've seen in the past, because what happened after 1980 is rates went back down, and now they're at ultra low levels, and that's driven a huge bull market in bonds. So between 1940 and 1980, you saw maybe between 2 and 3% average returns per year. Since 1980, that return figure has been more like 8 or 9%, I believe, average over the long run, because rates have continued to drop. If they rise again, I wouldn't be that concerned about it as long as you have a long-term outlook. If you have a shorter-term outlook, then you might want to think about reducing the duration risk in your portfolio. You might want to think about putting more in cash in the first place if you don't have the tolerance to ride that out. Now, the other reason that I mentioned, I don't even think that worst-case scenario is terribly applicable. And if you're someone who thinks that we're going to see 15 to 18% interest rates here over the next 5 to 10 years, I think you're crazy. Because yes, that did happen in the past. That's what we experienced in the 70s and 80s. But you're totally comparing apples to oranges with regard to the monetary system. Because the primary reason we saw that inflation was because we left the gold standard. Back in between World War II and prior to 1971, dollars that you own were exchangeable for gold held at Fort Knox. And then Nixon, when he was in office, did away with the gold standard for a variety of reasons. But inflation was a direct result of the United States leaving that exchangeability for gold. And that's a pretty typical thing that happens in the life cycle of capitalistic societies, is when you remove the store of value that backs your own currency, the US dollar is free to, the value of the US dollar is free to float around on its own. And we saw a lot of inflation pressure after we left the gold standard, which was eventually controlled by the Federal Reserve raising interest rates to get a handle on it. That's not going to happen again. We're not going back to a gold standard anytime soon. I sincerely hope we don't. That would be 4 steps in the wrong direction for us as a country. But on top of that, we're not going to see inflation like that again before the Fed gets a handle on things. They might be forced to slam on the brakes and raise interest rates substantially in the short run to get ahead of inflation numbers, but I highly doubt we are ever going to see anything like 15% again, at least in my lifetime. So even if you're someone who suspects that's going to happen, that's not really a good argument for abandoning the bonds in your portfolio. Remember, the purpose of having bonds in the first place, it's to be able to maintain a healthy allocation to stocks that's going to drive the growth that you'll experience long term. It's to be able to maintain consistency throughout all market cycles and be used as a buffer. If cash paid a better interest rate than 10-year debt issues by the U.S. government and corporations, then that might be a viable alternative too. Right now, that's not the case. So my firm belief here is when we talk about the relationship between bonds and interest rates, when you assume that bond returns are going to plummet because interest rates rise, I don't believe that's necessarily true. Bond prices will absolutely fall when interest rates rise, but that's a temporary thing. And for more details on the math that goes into this, I highly encourage this blog post written by Cullen Roche. And again, it's called What is the Worst Case Scenario for Bonds? And his website is Pragmatic Capitalism, pragcap.com. And we'll link to that in the show notes. So that's it for today. That's one of the myths that I run into a lot that I thought might be helpful to talk through. I've got half a dozen others that I'm going to rattle off here over the next couple of months in future episodes. So that's it for today. Hope you enjoyed this. I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.